Have you ever wondered whether years of marriage, divorce, or the loss of a spouse could still affect the pension benefits you receive today? If you were born before 1963 and you're now relying on retirement income in Canada, this is a topic worth understanding. Every year, many seniors assume that once a marriage ends or once a spouse passes away, the financial connections disappear completely. But Canada's public pension system doesn't always work that way. Depending on your circumstances, there may be benefits or pension rules that continue to matter long after those life events. The key is knowing which programs apply, what the eligibility requirements are, and what steps, if any, you need to take. One number that often gets attention is $1,573 per month. You may have seen it mentioned online, but it's important to understand what it really means. This is not a guaranteed payment that every Canadian senior automatically receives. There is no universal program that simply sends every widowed or divorced senior a check for that exact amount. Instead, your total monthly retirement income can vary depending on the combination of benefits you qualify for, including the Canada Pension Plan, Old Age Security, the Guaranteed Income Supplement, and in some cases, survivor-related CPP benefits, your age, work history, CPP contributions, marital history, years of residence in Canada, and current income all play a role. That is why being born before 1963 may be relevant for many viewers. If you are in this age group, you are likely approaching retirement, already receiving pension benefits, or reviewing your finances after major life changes. Perhaps you were married for decades before separating. Maybe you lost your spouse several years ago and simply continued with the benefits you already had, assuming there was nothing else to review. Many people never revisit their pension situation because they believe everything was handled correctly the first time. In reality, changes in your personal circumstances can sometimes affect which benefits you may qualify for or whether you should update your information with the government. Let's begin with the Canada Pension Plan, commonly known as CPP. Unlike some government programs, CPP is based primarily on your own employment contributions throughout your working years. Every time you earned employment income and contributed to CPP, you were building your own future retirement pension. The amount you eventually receive depends largely on how much you contributed and for how long. This means that no two retirees receive exactly the same CPP payment. However, marriage and divorce can still influence certain CPP rules. One of the most important concepts is known as credit splitting, officially called the division of unadjusted pensionable earnings. This sounds complicated, but the basic idea is fairly straightforward. If two people live together as spouses or common law partners and later separated or divorced, the CPP contributions made during the years they lived together may, under certain conditions, be divided between them. This adjustment can increase one person's future CPP benefit while reducing the others, depending on each person's contribution history. Many Canadians don't realize this option exists because it doesn't receive much public attention. Someone who spent years earning less while raising children or supporting the household may discover that a credit split improves their retirement pension calculation. On the other hand, someone with consistently higher earnings during the relationship could see their CPP record adjusted after the division is processed. The important point is that this isn't a bonus payment from the government. It's a recalculation of pension credits that were earned during the relationship. Now let's consider widowed seniors. Losing a spouse is emotionally difficult and financial questions often come later. One common misunderstanding is that a surviving spouse automatically receives the deceased person's entire CPP pension. That is not how Canada's system works. Instead, there is a separate benefit called the CPP Survivor's Pension. The amount depends on several factors, including how much the deceased contributed to CPP, the survivor's age, and whether the survivor is already receiving their own CPP retirement pension. If you are already collecting CPP retirement benefits and later become eligible for a survivor's pension, the two benefits are usually combined into one monthly payment. However, there is a maximum combined amount established under CPP rules. This means you generally cannot simply add two full pensions together. Service Canada calculates the combined benefit using specific formulas established in legislation. That's why two widowed seniors with similar life stories may still receive different monthly amounts. Another area that often creates confusion is Old Age Security, or OAS. Unlike CPP, OAS is not based on employment contributions. Instead, it depends mainly on your age and how long you have lived in Canada after turning 18. Being widowed or divorced does not automatically increase your OAS payment. However, these life events can affect your overall financial situation, and that is where another important program enters the picture, the Guaranteed Income Supplement. Many seniors overlook GIS because they assume it is automatically included with every pension. In reality, GIS is designed for lower-income seniors who already receive OAS and meet income requirements. Since eligibility depends largely on income, becoming widowed or experiencing a significant change in household finances could affect whether you qualify or whether your payment amount changes. Understanding how these programs work together is often far more valuable than focusing on a single number mentioned in headlines. One of the biggest mistakes seniors make is assuming that if Service Canada hasn't contacted them, then there is nothing else they need to do. While many benefits are processed automatically after an application is approved, certain changes in your personal circumstances still need to be reported or reviewed. A divorce, legal separation, the death of a spouse, or even a significant change in your income can affect your eligibility for certain benefits or the amount you receive. Ignoring these changes doesn't necessarily mean you will lose benefits forever, but it can delay payments or result in receiving less than you may qualify for. Let's take a closer look at credit splitting, because this is one of the least understood parts of the Canada Pension Plan. During a marriage or common law relationship, both partners may be contributing to CPP through their employment. If that relationship later ends, the pensionable earnings accumulated during the time you lived together can, in many cases, be divided equally between both individuals. This process is not about giving one person someone else's pension. Instead, it redistributes the CPP earnings that were accumulated while the relationship existed. Imagine one spouse worked full-time for many years while the other reduced working hours to raise children or care for family members. Without a credit split, the lower-earning spouse might have significantly smaller CPP benefits in retirement. A credit split can help recognize that both partners contributed to the household in different ways during those years. However, eligibility depends on specific legal requirements, including when the relationship ended and whether it was a marriage or common law partnership. Every situation is unique, which is why individual calculations matter. Another important point is that many Canadians mistakenly believe a divorce automatically triggers every pension adjustment. While some situations are processed based on provincial records or legal documentation, others may require an application or supporting documents. If you've never reviewed your CPP record since your separation or divorce, it may be worth checking that your contribution history accurately reflects your circumstances. Now let's return to survivor benefits because there is just as much confusion in this area. When someone receiving CPP passes away, the surviving spouse or eligible common law partner may qualify for a CPP survivor's pension. But eligibility is not automatic in every case, and the amount varies considerably. Factors such as the deceased person's contribution record, the survivor's age, and whether the survivor already receives CPP retirement benefits all influence the final calculation. Many people also ask whether they can receive both their own CPP retirement pension and a survivor's pension. The answer is generally yes, but with an important limitation. Under CPP rules, the payments are combined into a single monthly benefit, subject to maximum limits. This often surprises seniors who expected to receive two separate full pensions. Understanding this rule helps prevent unrealistic expectations and allows retirees to plan their finances more accurately. There is another payment that families sometimes overlook during a difficult time. CPP also includes a one-time death benefit for eligible estates or individuals who qualify to apply. While this payment is separate from monthly survivor benefits and has its own eligibility requirements, some families are simply unaware that it exists. During periods of grief, paperwork can easily be delayed or forgotten, which is why reviewing available CPP programs after the loss of a loved one is often worthwhile. Old age security follows a different set of rules. Since OAS is based primarily on age and years of Canadian residence rather than employment contributions, divorce itself does not change the amount you earned through the program. However, your overall financial picture may change dramatically after losing a spouse or ending a long marriage. That change becomes especially important when looking at the Guaranteed Income Supplement. GIS is income tested, meaning the amount you receive depends on your annual income and, in some situations, your marital status. For example, someone whose household income decreases after the death of a spouse may become eligible for a higher GIS payment than before. Others may qualify for GIS for the first time because their income has fallen below the required threshold. This is why updating your information with Service Canada is so important after major life events. Keeping outdated information on file could affect benefit calculations. It's also worth remembering that benefit amounts are reviewed periodically. Changes in income reported through your tax return can influence GIS eligibility in future payment periods. Filing your income tax return every year, even if your income is relatively low, is one of the simplest ways to help ensure that income-tested benefits are calculated correctly. Many seniors believe they don't need to file taxes because they owe nothing, but failing to file can sometimes interrupt or delay certain benefits. Another misconception is that every senior receives the maximum CPP or OAS payment shown in government announcements. In reality, maximum amounts represent the highest possible payments for people who meet all qualifying conditions. Many retirees receive less because they contributed to CPP for fewer years, earned lower employment income during their careers, or did not meet every requirement for the maximum pension. This doesn't mean anything is wrong with their payments. It simply reflects how the programs are designed. The most practical step any widowed or divorced senior can take is to review their current benefit statements, confirm that their personal information is accurate, and understand which programs they are already receiving. Knowing whether your income comes from CPP, OAS, GIS, or a survivor's pension makes it much easier to identify questions that should be discussed with Service Canada. Small misunderstandings today can lead to missed opportunities or unnecessary confusion later. Many Canadians spend decades working, contributing to the Canada Pension Plan, paying taxes, and planning for retirement, yet they never take the time to review whether their benefits accurately reflect their current situation. A major life event such as the loss of a spouse or the end of a marriage can change your financial circumstances, and understanding how those changes interact with Canada's retirement programs can make a meaningful difference. If you were born before 1963, now is an excellent time to review your retirement income. Start by asking yourself a few simple questions. Are you already receiving CPP retirement benefits? Have you applied for old age security if you're eligible? If your income is limited, have you checked whether you qualify for the Guaranteed Income Supplement? If you've been widowed, have you explored whether you're eligible for the CPP survivor's pension? And if you've gone through a divorce or separation, have you confirmed whether a CPP credit split applies to your circumstances? These aren't questions meant to create concern. They're questions that help ensure you're making informed decisions. Many people simply continue receiving the same payments for years without realizing that a review of their situation could clarify their entitlement or confirm that everything has been calculated correctly. Another valuable habit is keeping your personal records up to date. Changes such as your mailing address, banking information, marital status, or income can all affect how government benefits are administered. Reporting these changes promptly helps reduce the risk of delayed payments or administrative issues. It's also wise to keep copies of important documents, including separation agreements, divorce orders, death certificates, and correspondence related to your pension benefits, as these may be needed if questions arise in the future. Technology has also made it easier than ever to stay informed. Through your online My Service Canada account, eligible Canadians can review many details about their CPP and OAS benefits, monitor payment information, and update certain personal details without waiting for paper correspondence. If you're not comfortable using online services, a trusted family member or authorized representative may be able to assist, or you can contact Service Canada directly for guidance. It's equally important to be cautious about misinformation. Every year, social media posts, videos, and online articles circulate, claiming that all seniors are about to receive a new payment or a large bonus simply because they meet a certain age requirement. While government programs do change from time to time, most benefit increases follow official announcements and established legislation. Before making financial decisions based on something you've seen online, always compare that information with official government sources or speak with Service Canada if you have questions about your own situation. Remember that retirement income is often made up of several different pieces rather than one single payment. Your monthly income may include CPP, OAS, GIS, workplace pensions, personal savings, or other retirement income. Understanding how these pieces fit together gives you a much clearer picture of your financial future than focusing on a single headline or payment amount. If you're caring for an aging parent, another family member, or a friend who may not be familiar with Canada's pension system, consider encouraging them to review their benefits as well. Many seniors are unaware of the programs available to them, not because they aren't eligible, but because they never received clear information or didn't realize their circumstances had changed. Sometimes a simple conversation can encourage someone to ask the right questions and better understand their retirement income. It's also worth remembering that pension planning isn't something you do only once. Your financial situation can evolve over time. Annual tax returns, changes in household income, updates to government programs, and personal life events can all influence certain benefits. Taking a few minutes each year to review your pension information can help you stay informed and avoid unexpected surprises. The most important takeaway from today's discussion is this: being born before 1963, being widowed, or being divorced does not automatically guarantee a specific monthly payment, such as $1,573. That figure should never be viewed as a universal entitlement. Instead, your actual retirement income depends on your unique circumstances, including your CPP contribution history, your eligibility for OAS, whether you qualify for GIS, and, where applicable, survivor or credit splitting provisions under the Canada Pension Plan. The good news is that Canada's retirement system is designed to support eligible seniors through different stages of life. By understanding how these programs work and keeping your information current, you'll be in a much stronger position to receive the benefits you're entitled to under the law. If you found this explanation helpful, don't forget to subscribe to the channel and turn on notifications so you never miss future updates about CPP, OAS, GIS, Service Canada announcements, retirement benefits, and important pension changes affecting Canadian seniors. Thank you for watching, take care of yourself, and we'll see you in the next video.